This is actually quite interesting topic. It used to be that I was getting like a lot of questions. I saw a lot of questions around the topic, and what I thought it makes sense to create sometimes the content that is not useful only for like people working for like UA teams or growth teams, but for the people who are like starting businesses and like being the founders or like growing the smaller companies. When I work actually very closely with Google for Startups, I was working very closely with many investors, sometimes connecting startups with investors, sometimes connecting investors with startups. I was investors in a few projects as well, because there is like some process on the Google side that once you follow, you get permission for it. So that's why I thought it makes sense to a little bit share more experience and share more knowledge around that topic with you, because I think again it's really really challenging one. Of course, there is like whatever you would like to add the questions. Feel free to do it via Slido. In general, the investment topic is not easy now, because of course, if we look at how the industry looking, is like we saw this amazing growth during the COVID, when everyone was asking about gaming, especially about mobile gaming. Now we see that from the financials perspective, there is all investors are talking about generative AI. They have some interest in game tech, but of course, in gaming, they are less eager to talk. So let's talk about what is situation now, how this gaming looks like in gaming versus non-gaming, versus mobile gaming, what is investment perspective and what to avoid. So the first one is, if we look at the situation in gaming, it's actually very interesting data coming from Deal Room, which is like one of the probably better sources for information about in general, the investment in all startups. So in this case, it is actually showing the value for investment of all different categories, in general, all tech startups. And we see that that boom during the COVID was not just only on mobile or in gaming, it was in general in the tech. So we see that the last quarters were relatively lower than the previous quarters. But if we compare the data with the data for gaming, that slide in gaming was much stronger than in general. Yeah, so that's why if we hear that, okay, it's not so easy to find investor, because the data even shows that as well. That again, if we compare it, for example, okay, general and in gaming, it's actually way more challenging. And if we go deeper and we look at the perspective of the deals, we see that in general, in the last quarters, we saw less and less bigger deals. So in general, investors were preferring small investments. So that's why if someone was looking for 500,000 or 1 million, it was still much easier than, for example, if someone wanted to sell the company or get the B round for 15 million. If we go deeper and we look even not only about gaming, but in general in mobile gaming, it got even more challenging. And I will talk about that as well. So again, general, gaming, mobile gaming. So that's why if we talk about this mobile part, it became very challenging. It looks a little bit differently if we look at the size of the deals. Number of the deals, because here we have the information about the number of investments. We see that in general, that is general view. And here is the last quarter, which is just started. So that's why we shouldn't really look at that data. So that's a really important one. That's what's happening in the gaming, and then in mobile. So again, so we see that in general, that decline was stronger in gaming than overall, but it was much stronger on the deal size than on the number of deals. In general, that's why it's easier to find smaller investment, then find big one. Yeah, because especially the big one is extremely hard because even VCs, venture capitals, they saw that they actually lost money on a lot of deals they did in 2021 or 2022. The valuations are still not they had in the past. So what they saw is actually, again, even from the risk perspective, it's easier and better to give 5 investments, 5 million each, than give one for 25 million. If we go deeper and we even look at the perspective of what is that number of exits, because again, we have right now this investment sentiment that is showing what is happening in industry. We saw one side, which is the deals. Here we have the exits, because exits is actually that something that is inspiring the investors. Yeah, the more exits you see on the industry, the more people earn on those deals. So the more people are actually eager to invest. The less exits you see, the less the lower investment sentiment you see. So that's why I would say it's harder to actually find that investor. So again, that's the overall sentiment in terms of how many exits were in overall on all startups, gaming, and mobile gaming. So that's what really actually matter, yeah. So that's why actually when you see that a lot of VCs, a lot of investors, talking a lot about investing, but very often not investing, are actually coming from that space. Because on one side, it's much smaller number of exits, which was usually coming from the aspect that valuations are lower than in the past. So whoever is not forced to sell doesn't want to sell now, because he knows that, okay, if I wait longer, I will get better price than now. So that's why we see this kind of a bit kind of similar sometimes how we see in the real estate. Yeah, that in general there is kind of demand, but there is no really supply, because everyone is waiting till there is this kind of balance between the price that people want to pay and the price that people want to buy. And we see it actually exactly on this investment side. And if we go deeper, we see that the sentiment actually is actually coming not only by the declines, actually not coming only from the gaming, but it's coming from other verticals. For example, we see health, even health. Actually, if we look at the number of deals that now, so the number of investment were a few quarters ago, it's much smaller size than it used to be, and again, more on the deal size than of the number of those deals. But there's one actually very interesting and I think still optimistic view, because if we look at the data that I was showing before, like at the first presentation, we were showing the growth. I actually look at the data and I was trying to compare the growth of the revenue on the market with the number of investment that was happening on that market. And what is actually quite interesting to see, if we compare this deal value, what is happening on the market in terms of investment, and if we compare it with the growth rate on the market, we see that in general, once there is the growth of the market, more or less it's followed by 3 quarters later by the growth of the investment. Yeah, so that's why I would say I was a little bit so enthusiastic about this growth of this mobile gaming and this rise of these numbers in the last quarters, because again, a lot of that kind of negative trend on the investment side was coming exactly from all over and over the investors hearing about, okay, that the industry declining is actually on the downturn. But if they hear more and more often about, okay, the really industry is growing, more and more companies are giving really good financial results, then we see actually by the data that by definition, it should be followed up by the growth of the market as well. So that one side is really around the investment topic. Then there is another one which is really around the investment perspective. And I think one important point is when you're looking for investment is this kind of comparison. If what is the difference between taking investment from VC and angel? and not many people are actually seeing and understanding the difference. And there's actually quite huge difference. And I go step by step. So the first one, very obvious one, yeah. Of course, the size of the deal. Usually, angels are early, so they are usually the angels are giving much smaller money than, of course, VC, and that's obvious. But the second one, which is not so well known already, yeah. The first one is obvious, size of the deal, but second one is size of the shares. What is happening is that very often the VC doesn't want to talk with you as long as you do not want to sell at least like 15% of the company. So angel can be okay to get or buy like 3% or 2%, but it's very unlikely that VC will actually agree to take less than like at least 10, 12, but more or less around 15%. Why? Because usually the VC wants to have the person in the board, wants to actually have the real influence on the what's really happening with the company, how the company is behaving, versus usually angel can actually put some money. Okay, I will wait like a few years to see what will happen with that. Then, of course, there is topic around valuation. So it's very unlikely that you will get higher valuation from angel than from VC. Most likely, venture capital will give you more money for the same amount of shares, provided by, of course, more restrictions. But usually, of course, the VCs will have higher pockets. Then the next topic is, of course, that's followed by the flexibility of the deal. At the end of the day, what is important is that angel is giving his own money, so he can do whatever he wants. So, which means that by definition, angel is way more flexible in terms of how that payment will be done, or if it's maybe combination of investment and the credit line, or it can be maybe okay, if you achieve those milestones, you will get that valuation. If you achieve that one, you will get that one. Yes. So again, in general, flexibility on the angel side will be higher, versus venture capital is actually the company that it's not their own money. They're responsible for the money in front of the LPs. So they really need to actually put much more care around the structure of the deal. Then the due diligence. So in general, what is happening, and it's kind of a little bit sometimes advantage of the venture capital, that venture capital is doing that kind of due diligence. So I mean, angel, again, it's his own money, so he can say, okay, I believe you based on some specific ideas, so I will give you the money. Why not? Versus, of course, the venture capital is actually responsible for that money in front of LPs, which means that that deal will take way more time, but then it will actually kind of sometimes provide more credibility to the market overall. Yeah, because again, the venture will do like at least, okay, what is the structure of the company, where is it registered, who is the owner, what is the cash flow, and so on and so on. And then, of course, that comes to this validation of the business. Of course, depends on the scale. Sometimes this smart money is how it's called, which is some kind of combination of the knowledge and money is actually higher on the angel side, especially if the angel is from the industry. But then it can happen that, for example, if the angel is putting not a lot of money, or is taking very small percentage of the company, he will not have, for example, time for that company. Yeah. So again, depends on the details. Versus usually the venture, we see actually now, even if you look at the deals, now you see actually quite rarely that the venture capital deals in mobile gaming or gaming are done by general VCs. More often, you see either specialized VC that is specializing, for example, in gaming, so they have like kind of resources, knowledge around that, or it's kind of combination of specialized VC with more like general one. General one has more money because we see that in general, for example, gaming VCs are in general much smaller than like those really giant VCs that sometimes can have hundreds of millions of dollars. But even general VCs, they lost quite a lot of money in 2021, 2022. So now I see that they are very unlikely to lead the lead in mobile gaming or gaming. Either if they put the money, they usually want to have someone from the industry to lead that transaction. And then, of course, pressure on the founder. So in general, VC will give like higher valuation, but then will usually mean higher pressure from the founder, because in general, the VC is expected to have the exit from the company between like 5 to 7 years, which means that they are expecting that the company will grow at least, for example, during those 2-3 years, will get at least double, triple valuation, yeah. Versus, of course, usually the angels they will kind of put a bit lower pressure on the founder. At least that's what I saw from discussions with different founders as well. So that's around this investment perspective. But then there is another one which is actually showing quite interesting how the different deals are actually valued by the market. There is actually a few different measures to do it. One really good one, which is actually used quite widely on the market, is actually something called multiple, which is, in this case, we have enterprise value is multiplication of multiple multiplied by EBITDA, yeah? Which actually shows in general what is the sentiment on the market, yeah? The higher multiple, that means that the more is interest and the more like belief in that more belief in the market and in the specific business by investors. EBITDA is in general this revenue, like more or less this. I would say it's income, almost profit before the interest, before the taxes, and so on. So it's a kind of how much money net you have on the company. Yeah, that's EBITDA, of course. So multiplied by that is we say who have the enterprise value. And even if we look at that very closely, we see that, for example, the first, in general, if we like it or not, but financial markets, they have more trust into non-mobile business than mobile business. And we see it, compare it, for example, let's see the like Playtika multiple with, for example, Activision, or with like other like NetEase. So in general, Tech2 Interactive. So in general, we see now, if we go deeper, for example, comparing Playtika versus Electronic Arts, so that we see that both businesses had very much higher rates in the past. So in this case, maximum for Playtika was 27. It was see around 21, because again, so that's why everyone invested, because the values for the kind of net worth of those companies was much higher. In general, these multiples were much higher. Again, the interest in those companies was much higher. So that's why actually it creates different approach for the investor, and different like this environment for the investment. And we see that Electronic Arts, for example, has the maximum around 33, again similar time, but still if we compare it with, for example, like mobile businesses, it's a little bit at higher level than on non-mobile have higher than on mobile. And it's actually getting even more interesting if we start to compare mobile gaming and gaming with other businesses. So for example, in this case, Alphabet has, you see 18, and you see that in general, that's more or less the, let's call it this average for this big tech, which again shows a little bit the challenge for mobile, and that's why in many cases we have a lot of undervalued companies, because in general the investor sentiment it's not over the the business. Again, the higher multiple, the higher value of the company, even if the profit is lower, yeah. So see, for example, Alphabet, you have Meta, and for example, compare it with NVIDIA. So like generative AI, so that's why it's so hot, because if someone sees, okay, that company has, for example, like 1 million profit, and based on that, it's actually 10 times higher value, at least by the stock exchange, for example, than mobile company or like mobile gaming company or gaming company that have very similar business results. And of course, it's combination of the growth as well. So of course, so in this case, the valuation of the company, in this case, we have, of course, a lot of individual factors, but there's a lot of combination of sentiment in the industry and individual like results of the specific company. So that's why if we have, for example, really good industry combined with really good performance of the company, like in this case we have NVIDIA, then we have extremely high valuation. And in this case, we see actually like, for example, like Meta or Alphabet, or like, even Tencent, for example, they have really high growth of the EBITDA, but still their multiples are, for example, lower than in other, like, for example, generative AI businesses. And if we compare it with other, sometimes can be even more interesting if we start to look deeply, like very deeper about specific results. It's actually getting even more interesting if we start to compare it even on our side. For example, in Poland, again we have 10 Square Games. We had very high valuation, for example, in those 2021, 2022. Now we see they're more on the market, more or less now. Let's call it for the gaming, like kind of average for the sector would be around 9 to 10 in Poland. But for example, we see the like again Artifex Mundi, again really nice growth in the last months. But sometimes we have the companies that are actually able to persuade market much better. Like we see in general, the green one is the company, the kind of light one is the kind of sector. Yeah, so we see this, for example, like still play well in terms of multiple, still above the average in the sector, which means that they are able to show to the market that they're actually performing better than the sector. But for example, like let's see, if we look at the huge games, it's extremely undervalued company, because if we see that like average for the sector is around like like 8-10, and you see we actually it's the kind of the metric for the market is strong, like slowly growing, which means that okay, the market in general is rising. So the sentiment towards gaming is getting better, but still, for example, the company is very undervalued from that perspective. And then the last point, which is I think quite important, because so we had the landscape, we had the kind of investment, reality investment opportunities, and we had the kind of financial part of it. But what it means from the specific project perspective, I think it's a little bit simplification, but I believe it makes a little bit kind of sense that if you're asking someone for the investment, usually he looks at the kind of following perspective. You have potential risk and potential outcome. So if we start from that point is about okay, pretty low outcome and pretty low risk. What it means? It means usually that you have specific game that goes pretty well with the metrics, and there are specific metrics that defining pretty well the specific like genre. So okay, we know more or less, okay, if the really good game in match 3 has in general really good one, for example 45% day 2 in Western markets, then in general if you have like 35, 38, it's still pretty good project. Not really good, but still okay-ish, yeah? And of course, we can go deeper what those metrics are for like gaming, but not what those metrics could be, for example, in terms of different genres in non-gaming. Again, we have those benchmarks that define the quality and value of the game. And of course, if we try to go deeper and we try to have higher potential outcome with lower risk, that usually means that we see it now that like those investors and publishers are pushing more and more for those metrics. Yeah, so we know that even from this Pokemon Go example, that now it's not that you just publish the game and then it's end of the story. You have that game divided by different periods. Yeah, you have initial period when you just check what is the next day retention. Then you are adding the content. You are checking, okay, what is day 7, day 30, and so on. Yeah, and actually the more push you for those metrics, the deeper you push. Not investing, of course, the higher potential outcome and lower risk for your side. Yeah, so that's why you have so many like investors asking, okay, do you have the metrics? Do you have not just the early day 2 metrics, but do you have monetization metrics? Yeah, and that's natural way to really have higher outcome and lower risk. And we see actually that more and more projects are not just pushed, but they are really we have a few different ways when the project is pushed. We see the metrics, we see if it's fine or it's good for the scaling already or not. Then we work on that project again, and then we go again, and we see a lot of projects that exactly are going in the similar way. Yeah, we have a project, we push the traffic, we check the results, check the metrics, we see if it's fine. If not, we work again, push again. If it's not fine, we work on that again, and so on and so on. And of course, it's just the matter of this kind of game is that the more resources we have as the company, the easier it is for us to get to those metrics. That means very low risk for the investor, which means that he can just invest more at higher valuation because the risk from his perspective is lower. Yeah. But what is actually getting way interesting is that case when we think about those cases when we have the higher potential outcome and higher potential risk. And what is in this case? So you probably heard this famous saying from the Henry Ford. So if someone was asking, how to develop it and so on, like he was answering, okay, if I ask people what they wanted, they would have said they want to have faster horses. And that's the case in mobile gaming and in gaming. Because, for example, like, from the risk perspective, if we focus more on the lowering the risk, you will not try to do the role-playing games for female, for example, yeah? You will not try to do the strategy games for female, or you would not try to do the match 3 game for male, or you will not try to do the casual strategy, for example. Yeah. So there are like some kind of truths in the industry that define specific genre, which means that if you want to create specific game, you do it in the specific way, which means that finally you end up with good game. The people something know, but with something people know for a long time already. So it's like if you create another game similar to Survivor.io, or maybe using some mechanics or something like that, you cannot expect that that game will be like breakthrough, yeah? Only if you create something totally different, you can actually expect it. Okay, maybe new genre, maybe new, like again, those games like Archero, like Survivor.io, they almost created new genre. They almost created new behaviors, like Frozen City. They became very famous because they almost created new quality in the. But from that perspective, they were extremely high risk, which means if we look at a lot of investments, we see a lot of investments that are actually announced in very similar way. Yes, so we see like fronting gains raised like 2.5 for action-based hybrid casual mobile games, or like so in this case, so we have kind of combination of the so we have these cases when someone is trying totally new. So he wants to combine unique puzzle experience with specific elements that are not seen in the genre before. Yeah. So in this case, a lot of those investments are focused on that field. So creating something very unknown, very risky, but with much higher potential outcome. And of course, from the investment perspective, you would have much more VCs here and much more angels, for example, here, yeah, because angels are kind of trying to decrease the risk. And that's the easy point, of course. The hardest point is that, of course, those investors very often, they try to, in some way, minimize the risk as well. So they want to focus on high value, but they want to optimize the risk. So that's why very often those descriptions, for example, contain following phrase: industry veterans, people from like Playtika, huge games, and so on. So in this case, in the way they are optimizing the risk by investing in second-time founders, by investing in the people who have a lot of experience from the past, they kind of they can kind of more believe that the people kind of can deliver. So that's why I would say, whatever you create the deck, for example, for investor, it's not really like, there was a lot of discussion about, okay, how many pages it should have, like what colors and so on. No, it should be really focusing on making sure that you show that the risk on your side is much lower than I think initially. And of course, from that perspective, very often is that like, the companies you work on, or like similar topics are actually, it can be like even topics like, for example, like, people from well-known companies, people who work with the projects in the past, second-time founders, again, the people who know how to do the stuff, founders with complementary skills. So for example, like, if you, from the investors' perspective, is good to have situation when you have, like, for example, 2-3 founders, but each of them have complementary skills. Like, one is really good in growth, one is really good in design, and the third one is really good, for example, in technology. Yeah. So that's why you have usually those teams that are kind of getting that investment. Usually have, like, someone who was head of data at Playtika, head of design and King, and so on and so on. The few people that have totally different, different types of skills that combine together to create new value. Does the team knows each other very well and actually work in the past? It doesn't need to be in general it doesn't need to that you need to work in like very famous company. But if you create the company and you know each other before that company, it's better than you just, new people who just created just a few days ago. What is your time and dedication availability? So like, if you say to the investor, okay, I'm working full time and that's the project I'm working on after hours, it's no go from the beginning, yeah? Because no one will invest in something that is just done by very small percentage of the time, and there is very easy for founder to go out of that project. Yeah, I mean, if you work, for example, full time and you're doing that project after hours, it's very easy for you to opt out of that project. You just say, okay, I don't have time. Sorry. So those topics really matter if you have those discussions, if you think about those topics, and then of course it really matters around the understanding those business topics. Yeah. So for example, we had this discussions like in the last month that in general there is more and actually less and less games added to the stores, and more companies are is more focused on growing the current games that adding new ones. Why? Because there is specific challenges even about those early metrics like day 2 retention or early metrics about monetization. What we see very often is that if you start from the beginning, you have your first 10,000 users, it's so-called golden cohort that has extremely good metrics. But if you start to expand that game among users, more and more users are not so really attached to that game, and in general, the quality of the users with the scale is going down. And then on the other side, it's a totally different price if you want to buy, for example, 200 users per day, and it's a totally different price if you want to buy 20,000 users per day. Because there is just specific amount of users that can be done can be done at specific price. And if you combine those lines together, that's why actually that creates this challenge of the new projects. Because again, even from the risk perspective, it's not always to kind of persuade the investor that the game that has the economy that works for 5,000 users will work in a very similar way for 50,000 users. And the last topic, which is of course being very high risk and very low potential outcome. And what it is, I mean, it can be done in many different ways. But even if we look at the data, let's look at let's see AppMagic, and let's look at the games that are done based on the Survivor.io. So if we look at those games by the first sight, they could be even very similar to those in Survivor.io. But that is the money that Survivor.io is doing, and that is the money that the other copycats or other just copies of the games are doing. Which means that if you are thinking, okay, I would just do another Candy Crush game, or I would do another Clash Royale, or okay, I like the game, I will create very similar, almost the same. That means usually being classified in that bracket, and you want to be there because, of course, by definition, it's actually no go. Especially that if we look at the data, the quality bar for the new project is actually very, very high. Yeah. So even if we look, for example, at okay, what are the ratings for top games on Android, on iOS, we see that okay, it's not just that the games they became big and they became famous; they are very high quality. Okay, That would be all from my side. Again, just to summarize, investment environment is challenging, but whatever you talk with investors or like someone who wants to to invest, you again think about risk and potential, how to show that growing potential and how to show decreasing the risk. Again, DEC should be about showing high potential with low risk. And you can do it by, so that's why if you have a lot of discussions about, okay, the investing in gaming, investing in teams, yes, but it's just the way to decrease the risk. It's just one of many ways, and actually it's one of the simplest ways for the investors to actually understand, okay, that team knows what they're doing, they have a lot of experience, so it's very low chance that they will fail, or at least much lower than in the past. So it's not only about the deck, but about showing potential and no risk via those slides. And the same as in the past, that's my LinkedIn profile. Happy to connect.